It's a pleasure to be here. As Rich said, my name is Briggeman, professor here in the Agricultural Economics Department and also the director of the Arthur Capper Cooperative Center. So I do a lot of work with farmer co-ops, but today I'm going to talk with you all a bit on the macroeconomy, interest rate outlook, kind of give you some thoughts about where interest rates are going. Also kind of some of the things that the Fed is watching as well. So drawing on my experience before I came to K-State, I was an economist with the Federal Reserve Bank of Kansas City. And like I tell everybody, it's really great to do a Fed talk as not, employed by the Fed, because I can give you my opinion. It might be wrong, but I'll at least have hopefully some information there to back it up. But first thing, I got to who's rooting for the Royals today, right? I mean, I cannot wait till 3:30. I'm so excited. Actually, we were in Garden City yesterday, and then I realized that Rich put me on at 1 o'clock, which means I got to listen to the Royals on the way home, which was wonderful. Denny Matthews took me back to my days on the tractor, listening to him, give the play-by-play, which was fine. But there was a point when I was driving down I-70, I think it was like in the 8th inning, when Ursig came in with 2 outs and runners on first and second, and I was like, I really think I should pull over. I don't know if this is safe for me to be driving 80 miles an hour, listening to this, and my heart's just racing. I'm like, But anyway, so hey, got the win. So trust me, I could go on and on to get 45 minutes talk about the Royals if you want, but probably not why you're here. So anyway, so you have the slides, that will kind of follow along as we go. My style, if you have questions, comments, want to add to the discussion, please shoot up your hand, ask a question. Hopefully have some time at the end as well. But really make this a conversation as much as you all would like. So to start off, looking at the macroeconomy, just that their overall measure of the U.S. economic health, and really the economy is doing pretty well. Q2 of 2024 GDP growth estimate came in at 3%. That's pretty significant. Anything above 2.5%, that's a pretty strong signal that employers are doing well. We're starting to see labor, hiring, investment, things are moving along at a pretty good clip. The other thing that I like to point out on this graph is we are a nation of consumers. I think everybody could point to the point in the graph when we were told to go home and not spend money. That happens, right? Like you see a big drop, nearly over 30%, right, decline on an annualized basis when we went into the pandemic, and then a real quick snapback. And since that time, we've had pretty good growth. And even here recently, when we've had inflationary pressures, we've been doing pretty well. In fact, like it's forecasted for the end of this year to be right at about 2.5%. Now, moving into 2025, there's a lot more uncertainty, a lot more questions. What are we going to do? Now, the Fed met about a week and a half ago to vote on interest rates. And they voted to move it down 50 basis points. Okay, that was the vote. So we've gone down. We're now trading the effective Fed funds rate between 4.75 and 5%. Who in this room agrees with that decrease? Did we need to drop the Fed funds rate by 50%? Show of hands. Who's the brave one? All right, got one. Agrees that with it. Who feels that it should have been held flat? Show of hands. Show of hands. 25 basis point decrease. Okay, sure. So there was one individual that did dissent in that vote. Michelle Bowman from Council Grove, Kansas, serves on the Federal Reserve Board of Governors. And her response was, I feel that it should go down 25 basis points. But there's too many things in the economy that look to be very solid. Yes, she agrees that we need to move into a more normal policy. Being at that 5.5%, we need to move more towards normal. But we need to do it in a more measured pace, right? And I think that's very sound. That makes a lot of sense to me. If I had to vote, I would have kept it flat because, as you'll see here in a little bit, some of the things that I'm kind of monitoring, we cannot have a repeat of what happened in the 1970s of a double dip inflation, right? Where we feel like we have inflation taken care of, and then all of a sudden it takes off again. And I'm going to kind of show, at least my opinion, argument that stage might be set, right? That potentially we could see that happen. So I felt like we should have left it flat, but I mean, with what Bowman's vote was and her reasoning, can't argue with it too much. But I do think a 50 basis point drop was too aggressive, in my opinion. So just quick thinking about a macro talk. What are some of the macro factors for us in agriculture What should we be looking at? What should we be focused on? What should we be thinking about? So just go through and real quick show some of the connections of how ag connects in with the broader economy. So this graph here shows the ratio of the total value of production to the total value of gross domestic product, or GDP. And the value of production here, I'm talking commodities, right, and livestock production. So production, not necessarily those more, connected areas. So like food manufacturing, services, because I think if I did throw that into the numerator of this ratio, we would see that number go up. But it's still, if we look at this connection with production ag, it is very, very low today, less than 2%. Now, back in the 20s and 30s, it was closer to 14%. But over time, as we have become more of a nation of consumers and service-driven, we're moving more away from just really production. Even if I put manufacturing up here as a ratio, we would see that come down, right? We're more service-based economy. So thinking about those measures of GDP, it might not necessarily, okay, what's moving GDP? Do we really need to be honed in on that? If I did this graph for the state of Kansas, I had this question one time. If I did this for Kansas, it wouldn't be 2%, it would be higher, but it would only be about 8% if we look at it today. Now, again, we could push that number up more if we look at all the rural jobs that are supported by ag, right? We could have that as a larger component of the Kansas economy. But on a production basis, it's about 8%. And then if we look at the correlation of changes within GDP relative to changes in the value of ag production, there's virtually no correlation whatsoever. To me, farm kid, that makes sense. What are some of the things that drive ag production? What are forces that drive ag production? External stuff. What drives it? Rain. Weather. Weather is probably the biggest one, right? We're certainly experiencing that, have experienced it for a number of years. Rain, weather, we've had hurricanes. It really doesn't do a whole lot. Exports, trade policy, right? If you think about GDP as consumption plus investment plus government spending plus net exports, exports is actually most of the time is negative, right? It's a drawdown of GDP. But for us in ag, it's a big driver of it. Has a significant impact. So the GDP and changes in GDP, not really something to follow as much, but the closer we get to the consumer, the more connection that we have within the broader economy. So this graph, we do see some positive correlation between changes in food consumption relative to changes in GDP, right? And that makes sense to me. If we have more disposable income, we're going to feel better. Maybe we're going to spend more at the grocery store, move up the meat counter in terms of cuts. And if things are going down, we can see that, maybe pulling back a bit on those consumption. The one outlier here is, of course, COVID. GDP tanked, but we ate our way through the pandemic, right? We were just eating our way through. Crime rate is not helping me get rid of that eating that I did back in 2020, but the one outlier would be there. But in general, the closer we get to the consumer, that really does matter. So when we think about livestock talks that Glenn just gave you all, though, that's very close to the consumer. Right? So that's when you pay attention to what's going on there. I know some of the things he talks about with the meat demand monitor and consumer sentiment, that does have real implications for our livestock producers. But if we really, the one thing that I spend a lot of time on and thinking about for ag is interest rates. What is interest rate movements? How does that flow through? How does that affect us in ag? Has big implications. One I don't have up here to mention though is ag exports. Right? We've had interest rates come up, kept the value of the dollar pretty high, and that's a headwind on our exports, right? So that interest rates, that connection has a big one. Here in a little bit, I'll show connections within farm real estate, farm debt interest rates that are paid. But if we think about it, interest rates also have a connection within land, right? So here I have a chart showing real Kansas cropland values on the left, and then on the right, have it overlaid with real one-year interest rates. And a real one-year interest rate is just the one-year treasury rate minus inflation, right? And one thing I think pops up that's pretty clear, like when we see negative interest rates in real terms or very low interest rates relative to inflation, we do see upward movement tends to go with that on land values, right? Some of it is debt driven, like in the 1980s. That's cheaper. We can use that to go borrow. Not today. We don't see it really as much. But the way I like to think about it too is when you hold interest rates at the zero bound and you give investors a strong incentive to go reach for yield, I mean, they're also smart. They want to diversify their portfolios. If they can add in some land as well to that to help moderate some of that excess risk they're taking in, creates and helps spur some additional amounts of demand. Plus, debt's pretty cheap too as well. So we've seen, that upward momentum. One way to think about it is through capitalization rates. With lenders, we think about those things as well. But when we see interest rates come up and really spike, that's the question of, will we see land values come off like they did in the 1980s? Remember, 1980s, that crash, that was driven by forced land sales, which was more the last resort thing that farmers had to do, bankers had to do, because of a myriad of other stuff that was going on in the economy and ag economy. If our incomes were collapsing, we were, putting up tariffs and trade barriers on our exports. We had, interest rates were very high to fight inflation. There was a whole myriad of things that pushed that down. Today, we don't see that, right? We actually saw interest rates in 2023 go into positive real territory, and actually we had cropland values go up. And that's not driven by non-farm investors. I mean, that's driven by farmers having pretty healthy balance sheets and being able to bid up prices of land. Now, in some of, Robin tracks this a lot more than I do, but some of the reports that Lisa and I picked up while I was out in Garden City and then talking to some farmers out west, they are seeing some softening of land values. Multiple years of failed crops, higher interest rates, starting to see those maybe start to come back down. So at some point, we'll begin to see that, but I would not anticipate a big collapse. So interest rates really is what I want to spend the time talking about because that has a strong connection into what we do. So what is the future of interest rates? Where are we going? Well, first of all, look at the institution, the organization that has the say over interest rates, right? The Federal Reserve, the Federal Open Market Committee voted, week and a half, 2 weeks ago, to lower interest rates. And I think it's important to remember that the Fed has this dual mandate to have full employment and stable prices. And here on this graph, I show that mandate through unemployment rate and the Fed's preferred measure of inflation, the Personal Consumer Expenditures Index. Employment has come down. Our unemployment rate is going back up, right? And actually, that's a good thing. To see more people coming into the job market looking for jobs, see that move to that more full employment rate of about 4.2%. So labor market's improving. There's still some challenges there, but by and large looks pretty good. Inflation has come back down, right? We haven't hit that target level of 2%, but we're sitting at 2.5% and have certainly come down. So from a Fed mandate, maybe it is time to move into a more normal policy, right? Kind of look at it from that. If we dive a little deeper into the labor situation, really, the labor market is coming back into balance, right? When we look at the number of unemployed individuals within the US relative to job openings, they are coming back to a ratio of 1 to 1. So the graph on the left shows just those pure numbers. The graph on the right is that ratio. And I drew that line at 1 because when we're below that line, suggests the labor market is very tight. We have more job openings and we have people really in the market looking for jobs. And hey, everybody, if you want a job, you can have a job. And certainly coming off of 2020, that was the case. Labor market was really tight. That means wages have to go up, right? In order to incentivize people to come in, and that has inflationary pressures. But today it's moved more, into that 1 to 1 and maybe potentially moving up where there's more slack in the labor market. And some of this labor balance, if we look at changes within the labor market itself, this is from the Bureau of Labor Statistics. A lot of those, I just wonder, how can we continue to sustain this job growth? When we look at the pink bar of private education and health services and then government being next biggest, how sustainable is that? We look at manufacturing actually beginning to see some decreases. Manufacturing survey, if you look at the ISM index, it's below where it's in a contractionary period. We're starting to see maybe some concerns within the labor market in terms of its stability to continue to be. But by and large today, it has come into balance. The other side, why labor matters, is consumption, right? We're a nation of consumers, so we want to see growth within retail sales. And if we look at the real or inflation adjusted retail sales, it's really held pretty flat. Even though we've seen very, very high price movement up, right, with inflation. We've seen that hold pretty constant. Well, the wage growth that we have had has helped, but if you look at wages on an inflation adjusted basis, they're relatively flat. So then there's really two ways that we as a nation can prop up these sales numbers. What are those two ways? Really good at uncomfortable silences too. Debt, right? That's one way we can do it. And if we look at credit card debt, we are at all-time record high levels, right? So the graph on the left shows credit card debt. Before the pandemic, we saw credit card debt increasing at a clip of about 5% annually. Today, we paid it off, right? After we had the pandemic and we're told to shut in, we paid off our credit cards, but then it's been increasing at a clip of 11.5% annually. We are a nation of consumers. Come hell or high water, we are going to spend, right? That's what we do. What's the other way that we can support sales with debt? We talked about wages. What's the other way? Savings, right? So we don't have the graph up here, but we had tremendous amounts of excess savings, estimates of about a little over $2 trillion. Guess what? It's all gone. We have spent that now, right? So turning to credit cards continue to support. Now, if you look at a debt coverage ratio, comparable to say, all right, what income do you have available in order to support this increase in debt? As a nation, we're okay right now. So if we were to overlay some sort of, a repayment number, looking at household disposable income, we would be okay historically. But there are some cracks. The graph on the right shows those cracks. Certainly bank credit card interest rates have gone up with the green line. But if you look at those two red lines looking at delinquency rates at large banks and small banks, we've seen that rise. And in fact, to at least back to 1995, historically high levels. So there are some concerns, right? How long can this continue would be the question that I would have to support those sales. But of course, it's inflation. That's what everybody's concerned about, right? And wondering about. And we saw earlier that we haven't come down. The red line here has not come down to that 2% target, but it has improved, right? We've seen it come down. Even headline inflation, which includes more volatile items like food, commodities, we've seen that come down. But the question I have, or to make this point, why has it been slow to come down? One of the things, if you look at those inflationary measures that are more sticky, so things like housing, rent, health insurance, they're slow to adjust. And we are seeing housing, especially on the rental side, is beginning to improve, but it's taking time. It's slow to adjust to come down. So the reason we haven't seen the big drop off from there is largely because of those sticky items. That's the sticky inflation piece, that orange line there. But the concern I want to kind of spend some time thinking about is this right here, right? Like what were some of the things that happened back in the 70s leading up to that and during it that caused that period of stagflation? So we were in a recession, but we actually had inflation, right? Economy was stagnant. We had inflation. Typically, those don't happen, right? If the economy is in a recession, inflation is falling very rapidly, right? We have inflation, we typically have growth. So what was it that was unique during that period of time, and what is similar today? So really, could stagflation of the 70s rear its ugly head again, right? So I went back and just kind of thought through some of the different things that led up to that and during that period of time, and to consider where are we at today. Well, Back then, they had huge government budget deficits. I don't think I need to show a graph to answer this question. We have it today. Actually, I heard a comment on a webinar the other day. The person in the webinar said, as long as we have a US president, we will have government debt and deficit spending. And I was like, it's a good way to put it. It doesn't matter. It just seems that we continue to have this deficit spending. So certainly that period of time, well, we have it today. The other piece, during that time, we repealed Bretton Woods, so we moved off of the gold standard. We changed monetary policy dramatically, right? The Fed all of a sudden didn't have it tied to gold. It was now a fiat system where they had more control. And it was a huge, tremendous adjustment and a lot of unknowns. What are we going to do with that going forward? Well, today, I don't have my Fed balance sheet graph in here, but we've entered into a really unique period with quantitative easing. I mean, the Fed has picked a winning scheme. When we go into a recession, they are going to step in and buy mortgage-backed securities. They are propping up the residential real estate market. They picked one. What are the implications of that going forward? How does that change, the dynamic within the Fed? And we're going through a period of quantitative tightening where the balance sheet, actually, I did calculate this, we're back to where we shot the balance sheet up in terms of total assets right at the time of the pandemic. So it's now worked itself off to about where we're at right now. It changes the whole dynamic, right? When we think about monetary policy and some of the things that the Fed has there. So what are the implications of that? So it's similar. The other thing I'll put up here on crude oil prices, during that period of time, you had the gas lines and everything, and oil prices were through the roof. We haven't seen that today, right? We just have not seen that big increase in oil prices. Also at that time, we embargoed oil from Iran. I mean, we've had trade wars, we've had tariffs put on different things and not lifted. Could that happen? All those things to say, this is the one piece that I think is missing of this whole list that I have that really is preventing us from that stagflation. But when you hear things going on in the Middle East, you hear what's going on in Russia. I mean, are we that far away from having some sort of event that sends crude oil well above $100 a barrel? Potentially. And if that's the thing, if I was to say there's a black swan kind of thing that could really send the economy off the rails, it would be that. The one thing on here that at least when I look at the past and relative to today, it is missing. The confidence in the Fed waned during that time. There was a lot of questions, inflation, they were supposed to control it. They were not controlling it. Inflation expectations were not well anchored. Today, we don't see it at the moment. Things, as they have told the market, and you look at market estimates, inflation seems to be, at least in the market's opinion, under control, right? Doing what the Fed. So we do have faith in the Fed. We don't have that. And then, of course, we did have the wage cost spiral during that period of time where laborers, employees would come to their employer, hey, we're not being paid enough. We need higher wages. Goods are too expensive. Employers would pay them a higher wage. They would pass that cost through to higher prices. Then the employee would say to their employer, hey, goods are too expensive. We need higher wages. Wages would go up, and then they would pass it through, and so on and so forth. And we had that inflationary pressures really came through in there. Today, we maybe saw the beginning of it, but our economy is really different for this to happen. We're a service-based economy. We don't really make stuff anymore, right? We just don't. Back then in the 70s, manufacturing was a really important part of our overall economy. Today, it's important, but it's more on the goods and services that we produce. So that I think the fear of that, the double dip inflation is what the Fed and what Paul Volcker did to raise the Fed funds rate up to nearly 20%, where we saw that just huge increase. I think that's the fear. And we did have a really rapid rise in interest rates coming off of the zero bound up to the 5.5%. It happened very quickly. But yet it didn't really shake the markets much. It certainly didn't affect the stock market much. Home prices have really held up pretty well too. But now we're going in a period where the Fed is going to start to likely bring it down in a measured pace. If I was to predict what the Fed would do going forward, the 50 basis points, I don't think they'll do another 50 basis point. I think it'll pretty much be a lockstep 25 basis point drop down, with the target being about 2.5% to 3%. I think eventually that's where they're going. That's where I feel they would view more normal policy being. And a lot of that statement that I just made comes from the projections that the Federal Open Market Committee produces 4 times a year. So this graph, what it shows is all the participants with the FOMC, they provide a forecast of where they think interest rates should be at 3 years from today. So this is the longer term Fed funds rate. So looking 3 years out. If we go in 2012, I think what they were feeling was we were going to head back to a more quote unquote normal Fed funds rate of about 4 to 4.25, right? And if we look back at this chart, and if we look at this 4.25, typically during periods of time when it's more normal, they're kind of hovering right around that number. But we've been in the zero bound for quite some time. The economy has changed greatly. That number has come down to where it's probably more around that 2.5% to 3%. So if I think about where the Fed is going to go, that's their quote unquote more normal policy that they've talked about, that 2.5% to 3%. And that got me to thinking, actually, I was on a program with David Cole from Virginia Tech, and he made a statement that I forgot about, just kind of some old rules of thumb of banking, right? Like, how do we price loans, right? How do we think about it? So I was like, oh, well, I could take that methodology and apply it to what the Fed is telling us on their projection for the Fed funds rate and bring it into agriculture. So this is my thought process behind it. So we go from a prime or a Fed funds rate of about, let's say 2.5%, right? So start there, 2.5%. Traditionally, we would get to prime. So add roughly 3% to that. Add 3% to that, that gets us to 5.5%. And then we have to adjust to the loan borrower, right? Some risk adjustment for how, are they going to pay us back? What's their repayment history? Whatever, somewhere between 1% and 4%. If we use that rule of thumb based off of that longer run projection, interest rates should be between 6.5% and 9.5%. So again, Fed funds rate, add 3% to get to prime, and then add between 1% and 4% to get a range of where ag loan or loan interest rates should be. Okay, so that's the thought. So let's take that and overlay it with the Fed's projection. Just take that methodology, right? So what I did was I took the FOMC prediction or projection and then created a band over time to say in 3 years, this is what the agricultural interest rates should fall in, right? Should fall within that band. Okay. So if we look at it, before 8 to 11%, excuse me, today somewhere, that's 6.5 to the 6.5 to 9.5%. So somewhere in there over time. So with any good model or method, I want to see how well it does, right? Like, does it actually work? Can we overlay, interest rates to see how well did the Fed do in actually predicting where ag loan rates are going to go? So I went to the Kansas City Fed and pulled down their for farm real estate interest rates and just plotted it on the next graph, and just to see in 3 years in advance, does that actually hit, right? Does it actually fall within that band? So in other words, the 2012, well, that's actually for 2015, right? The 2023, well, that's actually 2026. Or the 2021, well, that's actually 2023. So looking 3 years ahead. So in this graph, that's what I did, was I plotted this yellow line that shows the reported farm real estate interest rate from the Kansas City Fed relative to where, in prediction. So again, in 2015, we should be, if we use this model, should be in that band. Well, the Fed does a terrible job. And this model might not work, right? It's maybe not as useful. But Matt, I remember one thing you said at a risk and profit one time, and I think I can illustrate it here. Matt made the comment that it's really tough to price things off of prime when we're in a zero bound interest rate environment. And guess what is going on during this period of time? You're in a zero bound interest rate environment. Things are awfully tough. Things are very competitive. Things, we're seeing interest rates are, those old rules of thumb kind of have to go away, given what the Fed has done, right? But something started happening right here in 2016. Right around 2016, the Fed started doing what with interest rates? Started increasing, right? We started to trying to move more back to normal policy before we hit the pandemic. And if we actually look at interest rates, they started to come back up. But then again, the pandemic hit, we went back down to the zero bound. But today, where we're at 5% Fed funds rate, those old rules of thumb tend to hold a bit better. So I think this is something that's important for lenders, especially, to think about if we go back into the zero bound environment, this is a lesson, right? The model does do a good job of illustrating that when we move into zero bound, the price of money goes way down, old rules of thumb, we might have to go out the window. What does that, mean, right? Just we have to be very competitive. We can't think about it this way. But with being if we're in a more normal interest rate environment, I need more data points to show this, but it appears that we would bounce around in that band somewhere within there. So to think about where, farm real estate interest rates might be going, another way to look at it is just what's its relationship to the 10-year treasury rate. 10-year treasury rate is largely used to price a lot of mortgages, and I would say farm real estate as well. And if you look at it historically, so again, using Kansas City Fed data, the purple line is that farm real estate interest rate from them. The green line is that 10-year treasury yield. There's pretty significant correlation between the two, right? They tend to follow each other. And I just built a real quick statistical model to capture that correlation and to use the forecast of 10-year treasuries, which I pulled that off of the econforecasting.com. That's this lighter green, that's the forecast. And then to predict where farm real estate interest rates could go if they follow past movements. And we can see that move down to around that 6.5%, 7%. So again, that would be for 2025. So if I was to say, where are we going on farm real estate interest rates, moving off of that 8.5, 6.5, 7 seems pretty likely, at least for what the market is telling us. But one surefire way to have lower interest rates is we go into a recession, right? If we go into a recession, we know what the Fed will do. We'll lower rates. So when will that happen? Some of you all have seen this before. I won't spend a great deal of time on this. I'm gonna leave time for questions, but looking at a yield curve has always, at least historically, has been the best leading indicator for if the US economy is going to move into a recession. Under a normal yield curve, we have short-term US Treasury rates, yields, are lower than longer-term yields. Pushing that into the market, what that says is the market is expecting the Fed in the future to have to raise rates because we're going to have growth, right? When we have growth, Fed raises rates, try to cool the economy. It's the inverted yield curve on the right, when we have short-term rates are higher than long-term rates, that creates the real problem, right? In other words, the market is expecting the Fed to have to lower rates in the future because of something is wrong, something is amiss. There's more of a premium on having shorter term treasuries, right? So we have that inverted yield curve occur. And historically, it's been a really good indicator of a pending US recession. So this graph, what I show here is I just took the 10-year treasury rate minus the 2-year rate. And when that line dips into negative territory, short-term rates, 2-year rates, are greater than long-term rates, 10-year rates. It turns negative, bad, right? Inverted. And if you look at it through time, when that inverts, roughly, 18 months or so from that point in time, we have a recession, right? Double dip recession in the 70s and early 80s, stagflation, high interest rates. We had the savings and loan crisis. The market was saying something's amiss. That occurred in the 90s. We had the dot-com bubble in the late 90s and in 2000. And the Great Recession with the real estate market challenges and problems we had. Went into negative territory, we had a recession. Of course, the pandemic, the market was not predicting a pandemic, but they were talking a lot about challenges within the financial system. And in fact, I think we saw some of that happen last year in March of 2023, where we had Silicon Valley Bank, had to run on deposits. Signature Bank went belly up because of their risky commercial real estate loans that they made, and First Republic with all the large deposits that left. So there were maybe some of those challenges. It's what the market was talking about in 2019. Of course, we had the pandemic that threw everything off, and we have been firmly in negative territory for some time, yet no recession. And many market pundits are saying, well, the yield curve shouldn't be used anymore, right? It doesn't work. And I don't know if I'm fully there yet, because they'll point to like, well, hey, the market is betting that the economy is not going to go into a recession. And actually, so when I pulled this September 23, the difference between the 10-year and 2-year was positive 0.18%. We were positive for quite some time before the Great Recession. We didn't know the real estate market was going to collapse. And Bear Stearns said, yep, hey, guess what? There's problems. And we had that, going into the dot-com bubble, savings and loan crisis. We did have periods of time where there was positive signals coming from the yield curve. I don't think we do not fully understand the implications of holding the zero bound interest rate for as long as we did. That's what we just don't know. So we'll see, where they come out. Now, I've been predicting like a recession for a while, and I still think we're going to go into a recession. If you were to pin me down, like what this time last year I was saying about this time frame, that's wrong. That's not going to happen. But looking into next year, there's enough challenges out there. We'll have to wait and see. So just some takeaways, for you all to think about. Some of the topics that I hit on, just thinking about the connection of a macro talk in with what you all do. It's about interest rates, right? And really also think about that connection within land. The Fed's decreasing to normalize, they're more aggressive than what market expected, but I do think they'll start to temper that, be more measured, and coming down to about that 3%, 2.5% mark. Looked at the farm real estate, approaching 6.5% to 7%. But at the end of the day, these things are outside of your control, right? I can stand up here and give you a prediction, a forecast, and thinking all about that. And if I'm being brutally honest, it doesn't really matter. What really matters is you building relationships with your borrower customers, right? Having those relationships, understanding what their needs are, pushing on them when they have challenges. Those are the things that really, truly matter, right? Those relationships, helping to navigate these, uncertainty that we have coming at us, as well as capturing some opportunities, because they're going to be there as well. All right, so Rich, I think I left time for some.
You've got time. Yeah.
So
go ahead and just repeat the question, then.
Yeah, sure. Any questions or comments or follow-ups? Yeah.
Maybe I forgot my economics. You picked 2% for inflation and 4%. Yeah.
So the question is, how did the Fed determine that the unemployment rate is 4.2% is quote unquote optimal, right? It's full employment. And then why 2% on the PCE or for an inflation target? The short answer is to it, it's highly debated, right? Of whether or not is 4.2 right, or maybe it needs to be a bit higher so we actually have people in the labor market looking for jobs, which would naturally push up that unemployment rate. Some people make the argument it should be lower. The inflation target of 2.5%, there is right now, it should maybe be higher at 2.5%, but the Fed has pushed back on that, saying no, it needs to be more at 2%. Because again, it's tied back to that idea that we need to have some measured growth, not too rapid of growth. So, there's studies and debates on that. I think where they land on it, it's easy to communicate about, with the 4.2 and the 2%. But it's, again, a hotly debated topic. Yeah.
I guess, and with the general economy being strong, but John Doe consumer battling interest rates and inflation for as long as we've had, I guess what further repercussions of a recession, of an extended recession would there be?
Yeah, so if we were to go into like a period of continued inflation, right? Because the inflation we've had has really hurt like that mid consumer, right? Not the wealthy, right? Because the inflation that we've had and high interest rates, when you have the stock market going really well and you have home prices that are up, that doesn't really affect, I mean, like the elite, like the top of our society, they're doing really well. But food price inflation, when we go to pay for groceries, we look at gas, it's still almost $3. I mean, that does hurt because wages haven't kept up with that. How long, can we have that? I mean, we've seen some of the ways that consumers have been working through that, right? Spending down their savings and having credit card debt go up. Wages are going to have to come up at some point, or else we're going to start to see more challenges for them. Where it would be real concerning for that middle class consumer is if manufacturers and kind of those more blue collar jobs are starting to be laid off. That's when it would be really challenging for them. We haven't seen that yet. But again, the labor market's coming into balance. If they do see consumer demand really does start to pull back because of all the things that you brought up, that's when you would start to see those layoffs begin. That would be really challenging. Now, how long can that last? That's anybody's guess, but I think it's more about we're at that tipping point, right? The Fed talks a lot about, are we going to have a soft landing? Are we actually going to be able to come off of these high interest rates and inflation and have the economy just kind of even out? It's only really, truly, some scholars say it happened in the 60s and 80s. Really, the only time it ever happened was in 1994, where we did have high inflation, we came down, but we were starting from a much higher interest rate mark than what we were. So we were looking at more like 9% as opposed to 5.5%. So I don't, those are the things that I would follow to see, how's it gonna, hit the middle consumer. We haven't seen it just yet, but there's enough stuff out there that it could. The timing, it's anybody's guess. Yeah.
Everyone has, all economists have the kind of things they look at. The one I was reading about was every time the Feds raised it up to the high peak, which again, they just dropped to the 0.5 point, was if they went back in history, every time the Feds went up and then started dropping it, that's almost naturally a recession followed. Have you seen that or studied that? So
the comment and question is, whenever the Fed hits their high of interest rates and they do an aggressive drop, right, beats market expectations of something like 50 basis points or lower, that's usually a pretty good signal of, hey, we're going into a recession. Yeah, I have seen that, and it does follow that. And I think it tracks also with yield curve, right, if you were to overlay that. And they're seeing things, and now they can say we want to move into more normal policy because they're trying to set the market for the quote unquote soft landing. But there's plenty of other stuff out there too, right? But I don't think it is what moves us into a recession. There's other fundamental underlying factors that happen. So I would argue it's more of a kind of a coincidence, whereas the yield curve would be more, no, there's some underlying problems here. Something's off.